Welcome to The Explainer. So glad you're here, because today we're breaking down a complete step-by-step roadmap to building wealth. We're going all the way from foundational market philosophy straight through to the exact tactical execution you can use right now with Canadian brokerages. So, whether you're just starting out or you're looking to dial in a complex trading system, this explainer is going to structure exactly how you should be thinking about your money.
Okay, let's dive into this. Here's our roadmap for today. We'll start with why the boring truth wins. Then we'll climb the 5 investment levels, master dollar cost averaging, map out buy zones and profit targets, and finally wrap up with Canadian accounts and brokers.
All right, part 1, the boring truth wins. You know, before we even look at complex strategies or tactical maneuvers, we have to establish the baseline default of the market. You really have to know what you're competing against out there.
So let me just ask you point blank, can you beat the market? I mean, we all have this deep psychological urge to outsmart the system, right? To find that hidden gem or perfectly time a trade. It's totally human nature to want to be the exception to the rule. But let's take a look at what the hard data actually tells us about the pros who do this full time.
89.5%. Just let that sink in for a second. That massive number is the percentage of active professional large-cap fund managers who fail to beat the S&P 500 over a 15-year window. We are talking about nearly 9 out of 10 full-time professionals, people armed with whole research teams and Bloomberg terminals, who literally cannot outperform a simple passive index fund.
Crazy, right?
And honestly, this brilliantly illustrates exactly why the boring strategy has to be the default. Take Buffett's famous bet, for example. A plain, basic S&P 500 index fund completely crushed a hand-picked basket of hedge funds over 10 years, like 125% to just 36%. Then you've got the behavior gap. In 2024, the market returned a solid 25%, but the average investor only saw about 16.5%. Why? Because they panicked and chased performance. And get this, if you try to sit out the bad days, you are almost definitely going to miss the best ones. Missing just the 10 best market days over 20 years literally cuts your ending balance in half. So basically, any deviation from just buying and holding absolutely must earn its place.
Moving on to part 2, the 5 investment levels. Once we accept that boring truth, we can safely map out our actual investment journey without the illusion that we need to be, some kind of market wizard.
Think of your wealth-building journey like a ladder. Level 1 is dollar cost averaging into broad index ETFs. It's your rock-solid foundation, and honestly, stopping at level 1 is a completely respectable end state. It is not just a beginner phase. Then, level 2 adds paced buy zones for those of us who just really want to optimize our entries and tinker a bit. Level 3 introduces diversified allocation, so mixing in assets like gold or fixed income alternatives like Sukuk to help shallow out those market drawdowns. Level 4 uses factor tilts, targeting specific things like momentum or quality value over a really long horizon. And finally, level 5 is active trading. This should be treated strictly as a swing lab with carefully capped capital. Basically, you only climb as high as you're willing to work.
Okay, part 3, mastering dollar cost averaging. We're going to zoom in entirely on the specific mechanics of levels 1 and 2 to really nail down that reliable foundation.
So, dollar cost averaging, or DCA. This is simply investing a fixed dollar amount on a fixed schedule, totally regardless of the asset's price. What I love about this is how it perfectly disarms that paralyzing fear of, oh, is right now the perfect moment to buy? You don't have to predict the future. You just have to respect your schedule. When prices are sky high, you buy fewer units. When prices tank, your fixed cash automatically scoops up more. It's practically foolproof.
Now, what's really interesting about this slide is the contrast between the 2 main ways to run this system. Standard DCA is blind consistency. You put, say, $500 to work every first of the month, rain or shine. But buy zone DCA, that introduces targeted discipline. You hold your earmarked cash and only deploy it when the asset's price pulls back into a historically attractive zone. It definitely requires a lot more patience, but man, it can significantly lower your average entry price.
Now, if you're going to use buy zone DCA, here's how you actually do it practically. The golden rule here is progressive deployment. Do not, under any circumstances, dump your whole budget at the very first sign of a dip. Instead, divide your cash up into 3 to 5 chunks. Maybe you deploy 25% right at the top of the buy zone, and then you reserve those larger portions for if the price drops deeper toward your stop loss. And hey, if the price rallies early, that is perfectly fine. You just retain that dry powder for the very next setup. No big deal.
All right, part 4, buy zones and profit targets. Let's shift gears now and jump straight up to level 5 of our investment ladder to see how to actually execute a tactical trade with explicit signals.
So here is the life cycle of a truly disciplined active trade.
Let's say on day 1, the asset enters your computed buy zone and you accumulate your position. Fast forward to maybe week 2, and the price hits TP1, take profit 1. At this exact moment, you systematically sell 50% of your position. Immediately after, you move your stop loss right up to your original entry price, effectively moving it to break even. And then, let's say by month 1, the price hits TP2 and you execute a full exit. The key takeaway here is that these levels are computed daily from market price structure. It completely removes human emotion from the heat of the moment.
I really want to lean into the sheer psychological relief this specific structure creates. Once you've taken profit at TP1, the remaining half of your position is basically running on house money. You've already locked in a real, tangible gain. So if the market suddenly reverses and hits that break-even stop we talked about, you still walk away with the profit from that first half, taking zero loss on your original capital. It just makes it emotionally possible to hold the rest of the trade without freaking out.
But, and this is absolutely crucial, none of that works without this strict rule. Set your stop loss before you enter, not after. The stop level defines the exact point where your entire trade thesis has failed. You have to make that hard decision when you're calm and analytical, not when you're bleeding cash in the middle of a massive drawdown. Moving a stop loss downward during a trade is just, well, it's a recipe for disaster. Don't do it.
Okay, finally, Part 5, Canadian Accounts and Brokers. We've covered all this great theory and strategy, and now it's time for the payoff, how to actually execute this efficiently in Canada. Because let's be real, structure matters just as much as strategy.
Picking the right account type here is often worth way more money to you than any single trade idea. The TFSA, it is the undisputed king. For 2025, you get $7,000 of room, and all growth and withdrawals are completely tax-free. You absolutely want to fill this one first. Then you have the RRSP, which is tax-deferred, perfect for reducing your current taxable income. The FHSA is this incredible hybrid if you're a first-time homebuyer. And finally, the non-registered account. This one is fully taxable, so you really should only be using it after you've totally maxed out your other tax-advantaged accounts.
So, the crucial point here is how you pair those accounts with the right broker. If you're buying US-dominated ETFs, FX fees will absolutely eat you alive. While simple is amazing if you're an absolute beginner buying Canadian ETFs, but they charge a hefty 1.5% fee on US dollar conversions. However, over at Questrade, ETF buys are free, and you can use a clever little technique called Norbert's Gambit to convert your Canadian dollars to US dollars for roughly 0.2%. Mathematically, saving that 1.5% fee on every single purchase is going to completely supercharge your compound returns over time. Oh, and Interactive Brokers is also fantastic if you're an experienced trader looking for rock-bottom FX rates.
Now, applying this to Sharia screen portfolios, the source material breaks down the landscape really impartially. If you're a Wealthsimple user and you just want to avoid FX fees entirely, CAD-denominated options like WSHR are super efficient. But if you're building a portfolio with USD-denominated screened ETFs, think SPUS, HLAAL, or the Sukuk ETF SPSK, you're dealing in US currency. That makes Questrade, paired with Norbert's Gambit, the mathematically optimal setup to avoid unnecessary friction. Basically, your broker's choice strictly dictates your most efficient currency setup.
For conservative portfolios looking to add physical gold and silver, the source gives us a neutral look at how different Canadian products align with Sharia compliance, specifically regarding physical allocation. The strongest structure they highlight is the Questrade Trade Desk, where you own segregated, specific numbered bars. That's the closest to classical possession. Then you have the Sprott physical trusts, like FIES, which hold fully allocated metal in a trust. Highly practical for smaller balances if you want to use the ETF route. Finally, the Royal Canadian Mint products. While they are government-backed and CAD-denominated, they use an unallocated pool structure, which the source notes does raise some Sharia compliance concerns regarding specific asset ownership. And that brings us to the end of our roadmap. I want to leave you with this final, provocative question. Which rung of the investment ladder are you currently standing on? Are you consistently executing that reliable Level 1 DCA? Or are you maybe accidentally attempting Level 5 trading without the right discipline or the right Canadian broker setup? Take a look at your accounts today, align your strategy with the evidence we talked about, and just let that boring, beautiful discipline do the heavy lifting for your future. Thanks so much for joining me on this explainer.